Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. We're also joined by special guest star and DKI intern, Alex Petro. How are you, Alex?
I'm very well. How are you guys doing?
Good. You've got exams next week. Are you ready?
Yes, I've been busy with some DKI work, but they should go well if all goes to plan.
All right. Robb, where are you today? I know you've been traveling.
Yeah, it was a early morning drive up to Northern California, so a little bit right outside of Sacramento. Just curious if Alex has been picking any fights or battles with anyone lately.
Only as professors.
Yeah. Well, luckily I've been constrained to the comfort of my home for Christmas, so only my parents have been getting the
Safe place,
A-
safe place.
Alex is on house arrest in Great Britain, being in favor of Austrian economics and being against MMT, modern monetary theory, gets you put under house arrest.
true crime against humanity here in the UK.
That's
Yeah, that's
right.
exactly
Yeah.
right.
If you say anything negative about the pound, I think the police come and arrest you.
Too good. Gary, we got a fun issue of this week's Five Things, calling it the Dollar Milkshake Edition. If you're watching this, might be Christmas time, Hanukkah started. So happy holidays to everybody out there in the DKI community. Thanks for tuning in again for this week. We're talking Federal Reserve, talking China, Tesla. I got a lot lined up for this holiday version of the Five Things. Again, this is the Dollar Milkshake Edition. Gary, we're going to start with the Fed. The Fed recently cut rates, and we're going to talk again inflation. Thing number one, Gary, the Fed cuts again and increases inflation projections. Oh no.
You know, Rob, I got to tell you, we're rolling into 2025 here, and I am desperately hoping that we will not be talking about the Federal Reserve every week. Every week, I keep trying to not talk about the Fed, and every week they keep doing the same thing. So here we are. Last week, the Federal Reserve completed its final meeting of the year, and as expected, surprising nobody, they cut the Fed funds rate by 25 basis points. The current reference rate is, depending on whether you're buying or selling, borrowing, or lending, is 4.25% to 4.5%. For those of you who were keeping score, that is a total of 100 basis points or 1% cut since September. That's obviously going to be the final cut of the year. Now, their press release, while acknowledging we've got an uncertain employment situation, which we've talked about constantly on deep knowledge investing, the only reason we've had any kind of employment growth is because the government has been buying it. It's all the growth has been in government jobs. But the press release also commented, ready for this one, on elevated inflation and expanding economic activity. Exactly the thing that you don't cut rates into unless you want more inflation. So the Fed is saying that they've achieved a balance in trying to reduce inflation and maintain high employment. My view is that's not right. I think inflation is too high. And the only reason the employment situation isn't a disaster is because of additional government stimulus. So basically, what the Fed was saying is, yeah, we've got a lot of stimulus and too much inflation and expanding economic activity, so we're going to cut rates. That makes no sense at all. I also think it's notable that Beth Hammack voted against the 25 basis point rate cut. The reason that matters is the Federal Reserve almost always does everything unanimously. So the fact that there was somebody openly dissenting, saying, no, we shouldn't be cutting, was pretty interesting. But Rob, all of the interest and the reason the market went down hard that day and the next day is precisely because of the dot plot. Now, for people who don't do this all day, every day, the dot plot comes out a few times a year. I think it's 4 times a year. And what each Federal Reserve governor does is they put their estimate for where they think the Fed funds rate will be at the end of this year, the end of next year, the end of the following year, and a long-term number. And so when you look at that, a couple of things come to mind. One is the Federal Reserve is never accurate with this stuff. Their own projections are horrendous. And, Andrew Brown, former intern, he and I did some really interesting work on that and realized the Fed has no idea what they're going to do, even with the thing that they control. Um, But the other thing is the ranges are very, very wide. And you'd be amazed that, the Federal Reserve, you've got people voting or putting dots on the plot that could be 1% apart or 2% apart. At any rate, the big news is that even though the Fed cut, they increased their estimate for future inflation and decreased their estimated number of future rate cuts. So to give you an example, after the last dot plot, the Federal Reserve was saying, we think we're going to cut 100 basis points or 1% in 2025. That's already been cut in half. The 2026 number, that got cut as well. That estimate rose from 2.9% to 3.4%. Those are big changes. It may not sound like much, but at that level, it's a lot. And it implies expectations for a total of 100 basis points of cuts over the next 2 years, down from the 150 they'd expected before. So if any of you have heard finance people talking about something called a hawkish cut, that's exactly what this was. They cut rates. That's a dovish move, but they signaled, we think we're going to have more inflation in the future and fewer rate cuts in the future. And so that's a hawkish move. So it's being referred to as a hawkish cut. Concerns that rates and inflation would be higher than expected in 2025 and 2026. That's what took down the market in the middle of last week.
Gary, so what we're seeing is that there's indication that the Fed is not going to make any progress reducing inflation in 25. Obviously, as you mentioned, the market traded down. What does that mean for our portfolio? How are you looking at this? How are you positioning yourself?
Well, so you're asking the right question there because, first of all, it's amazing to me. We've talked for the last few months about how right after the Fed cut in September, every inflation metric, whether it's the CPI, the PPI, the PCE, they all started rising. That's not where you want to be if you're the Fed. And because they increased their inflation expectations for next year, they flat out said they expect to make no progress reducing inflation in 2025. So basically, they're saying we think there's going to be more inflation. Now, DKI subscribers are well positioned for that. I have been, very hawkish and of the opinion that no matter what happens, we're going to get a lot more inflation. So, the DKI portfolio is well positioned for that. We are loaded for more inflation. We anticipated this. And, as horrible as inflation is and as much difficulty as it extracts on people, we're expecting to make money from it. And it sounds terrible, but, our subscribers losing money is not going to make anybody's price of eggs and milk go down.
Great stuff there, Gary. We'll keep eyes as we move into 25, and I have a feeling this will not be the last we hear about inflation or talking about inflation on the 5 things. Gary, moving to thing number 2, we're talking retail sales again. We've been talking about this a lot over the last couple of months, Q4 especially, as we're rolling into the holiday season, getting Christmas here kicked off, Hanukkah, as we mentioned. Gary, we're talking here retail sales coming in high, but we're seeing that begin again because of inflation. Thing number 2, Gary, we're talking retail sales.
All right. So the last month's retail sales number came in at 3.8% year over year, which, that's kind of high-ish. It's not great. Worth pointing out, and this is really important, most of that 3.8% increase was not people buying more stuff. Most of it was just inflation. Right. So people are buying more stuff, but they're paying more for what they're buying. But where the where the sales report was really aggressive was the month over month number came in up 0.7% from the prior month. If you annualize it, that's the math I was just doing when you saw me looking away. If you annualize it, that annualizes to 8.7%. That is a lot of consumer buying. And so, what's really interesting is we've talked a lot in recent weeks about weak retail sales and all the full price retailers who are struggling, not having an easy time of it. All right, fair enough. But people are still spending, and they're spending a lot of money on necessities. And I'm just going to point out again, the Fed just cut rates into people spending. Like this is the thing that they want to cool down, and they're not. They're cutting into increased spending, increased economic activity. It's not the right move by the Fed, but boy, people are spending a lot more on necessities. If you believe, and I do believe the information we've seen, which says that discretionary goods sales are down, but non-discretionary, the necessities are up. And I think that's what we're seeing here.
Gary, are you seeing any signs of a potential rebound in the markets? Any indicators, thoughts on a rebound?
Well, it's hard to say on that because so much of our economy is driven by government policy. With that said, they're not cutting spending. Small government people, they were cheering, last week's um, budgetary showdown where, because citizens stood up and argued, we saw a 1,500-page spending bill cut down to, something like, I don't know, 117 pages, something like that. But the truth is, the US government is not cutting spending. Both parties overspend. And whether that's in the White House or in Congress, everybody likes to spend a lot. November often serves as an early indicator of holiday shopping trends. And so a lot of forecasts have suggested a weak holiday season. But, results like this, we could see a surprise to the upside. It really depends on how much of that 0.7% monthly increase was due to people buying necessities or how much room there is for them to buy, um, discretionary items like gifts for the holidays. So it'll be really interesting to see what happens. I was going to say over the next couple of weeks, but the truth is Christmas Eve starts tomorrow. We're filming this on Monday, the 23rd. So we'll see. We'll find out, I guess, a month from now what the holiday sales look like.
I'll try and do my best because I am the type that's the last minute shopper and still got a few more things to do. I'll probably find myself at the mall tomorrow, so we'll see how that goes. Maybe I can turn it around for everybody.
Yeah, you'll be the man. If that's the case, Rob, call up the Federal Reserve and let them know you're going out with your credit card in hand, and they need to take it easy on the rate cuts.
There you go. You're watching the five things. This is the Dollar Milkshake edition from Deep Knowledge Investing. Again, be sure to head to our website, deepknowledgeinvesting.com. Sign up for our newsletter. That's free just with an email address. You'll get notified of content being posted to the site. Some of that content, though, not the five things. Things goes out to everybody, but some content will be paywalled. So we'd love if you'd also consider a premium subscription, access to current recommendations, special member-only webinars with select individuals throughout industry, and really allows us to provide continuous research and support for our subscriber base. Moving to thing number 3, we're going to pull Alex into this one in terms of conversation. We're talking China and their economy. We've talked about this in the past as well, just the struggles that are there. We saw bond yields down a lot. Thing number 3, Gary or Alex, China, a snapshot of contradictions. Whichever one of you wants to take that one first.
Take it over, Alex. Go.
Yeah, so we have seen, the 10-year and 30-year Chinese government bonds are obviously, I think, at their lowest ever. And I read a fantastic thread recently by Macro Alf, and he was explaining kind of why this is happening and why China are cutting rates so much. And it kind of really goes back to 2008, and after the 2008 crisis, a lot of the Western countries, they had a lot of private debt, but they managed to deal with that problem, and China has not dealt with that problem. And so Macro Alf was saying that the private debt to GDP is ratio is around 200%, and we saw Carl Bass say more like 350%, and obviously that's a wide range, but either way, I mean that's massive. And so China, and this term Japanification, which we've heard a couple of times on FinTwit and online, and China is essentially trying to do what Japan did in the 90s when they had their housing bubble. And I think Japan tried to cut their rates from, they slashed them from about 8% to 1%. So, just stimulate as much aggregate demand as possible, because the deflationary pressures were so strong. And, China is having the exact same problem. And so China's corporate debt from 2010 to 2016, that really started to pick up, and then it got kind of shifted, into the housing market. And right now it's looking like, they may have to push it up to the sovereign level. And so, there's a lot of speculation about potential yuan devaluations in the future. And, I that's what I'm expecting.
Gary, anything you would add to this point, questions that you might have for Alex to elaborate on?
Well, the one thing I want to clarify, when Alex talked about the Chinese government bonds being at their lowest level ever, he's talking about the yield. So the
Yeah.
bonds are actually more expensive than they've ever been. It's the yield that's down. And what that means is that people are paying a lot for Chinese bonds. And as a result, the interest rate that they're getting is a very low interest rate. It's the same thing that we saw here in the US, basically the prior 15 years ahead of COVID when we were, when we had our Fed funds rate around zero. And I think, the US 10-year was trading below 1% for a substantial part of that time. So that's basically what China is doing right now. They know they've got a problem and they're stimulating. And, that's actually not a bad thing for Las Vegas Sands, which is, one of our stock picks. Because basically, if the Chinese government is going to stimulate and spray money into the economy, just like our government did here, well, that's not bad if you're running a gambling establishment.
Alex, anything else before we close out this point?
No, that's all from me. Thanks, Rob.
Moving to thing number 4, Gary, we're talking Tesla, ticker TSLA. Tesla stock has had a big run up over the last week or so. Tesla, thing number 4, Gary, why Tesla is soaring.
Yeah, so, ahead of President Trump's election win last month, Tesla stock was trading right around like the 230, 240, $250 level per share. And, when we did this chart last week, it was right around $480. That run up has allowed Elon Musk to reclaim his title as the richest man in the world with a net worth now of approximately $400 billion. Just a reminder, you could be the richest man in the world just a few years ago with a net worth of 200 billion. So things are going pretty well for him. But the thing that we're finding very interesting about this is this huge run up in Tesla stock has happened at the same time the US government is talking about eliminating subsidies on electric vehicles. Now, I actually think that's a good thing. If people want to buy the car you want, the government shouldn't be trying to influence people and saying, if you buy the car we want you to have, we'll give you money. On top of that, some of those subsidies, I think they were in like the $7,500 range. I remember at some point, I think there were like $9,000 subsidies. I'm not sure on that, but I know there were $7,500 subsidies. And, it's kind of obnoxious for people who are buying a $90,000 new car to get a $7,500 taxpayer gift from that, while, the guy who's making $50,000, $60,000 a year, maybe driving to work in, a $7,000 car. So, those subsidies were always a bad idea. They always distorted the market and it shouldn't have happened. But the real question here, which I'm assuming you're going to ask, Rob, is wait a minute. If the government is cutting subsidies to electric vehicle buyers, why would Tesla stock be going up? Is that what you were going to ask?
Well, I was going to ask that, but I'll have another follow-up question ready for you to rock and roll. So why don't
All
you take
right,
that one, Gary?
we're on it. And the reason is because Tesla was very effective in getting to market with product that people wanted faster than everybody else and taking advantage of those subsidies and positioning themselves as, the world's leading EV maker, certainly the leading EV maker in the United States. And now, Tesla's established themselves. They're making, millions of cars and, doing extremely well. It's the other automakers, Ford, Rivian, General Motors, where they're losing a fortune on their EVs and they really need those subsidies to make this work. So there's long been a really unfortunate, I want to say tradition, an unfortunate practice between the government and companies that are leading their industries, which is the government will regulate those industries at the request of the market leader. And that sounds a little bit crazy, except it's really about knocking out the competition. So if we look at examples from other industries, Amazon.com was actually one of the companies leading the charge to say, we want tax paid on internet sales. Now, that seems kind of crazy. If you're Amazon and you have the opportunity to sell at a discount to Walmart or Costco or any bricks and mortar retailer, to Best Buy, not having your customers have to pay sales tax is a huge advantage. So why did they do it? The reason they did it is because sales tax is complicated. You have 50 different states with 50 different rates, but a lot of cities have different sales tax levels, and sometimes it matters, where the seller is, where the distribution is, where the buyer is, and it's very complicated. So if you're Amazon and you're the market leader and you have the money to pay for the software to figure out how much to charge people, you say, yeah, let's just make this business hard for everybody. We can absorb the additional difficulty. We saw the same thing also with banks. When you see the US government regulating banks with a heavy hand, guess what? Those regulations make the banks less profitable, but the banks want those regulations. And the reason is it prevents smaller banks from becoming big banks. They want to make things more difficult. That's where Tesla is right now. They have established themselves. They are the market leader. They're I don't know that anybody else in the country is making money selling electric vehicles. And so what Tesla is saying is, yeah, no, just get rid of the government subsidies. Now, would Tesla love their customers to get a $7,500 discount? Of course they would. But what they really want is to not have competition. They'll say, yeah, we'll take the hit of a tougher competitive environment as long as Ford and Rivian and General Motors and the other automakers don't have any advantages either. We'll compete on a more difficult level playing field because it's going to make things much harder for them. We can handle it. And so, listen, I can't argue, even though it was self-serving, I can't argue with Elon Musk on this. The guy who is going to be heading up with Vivek, the Department of Government Efficiency, DOGE, is saying, let's cut government subsidies. So he's right on it. And the fact that, he might be self-interested on it doesn't change the fact that it is the right move. And so, we support it.
Gary, I know Tesla is not a current part of the DKR portfolio. Not sure that it ever has been in the past, but you correct me if I'm wrong there. Does this change your outlook position on Tesla from an investment standpoint?
No, it doesn't. Look, it's a phenomenal company to the extent that, like Apple, they make product that people really love. Right? People who own Apple products will not stop talking about how much they love their iPhone or their Mac or whatever. Like it's a religion to them. And Tesla enthusiasts are very much the same. And so, good for them. That's amazing they've been able to do that. But the company there have been questions about their accounting in the past. I think a lot of that's gotten cleaned up. There are also questions about the valuation. It's not a large automaker, but you would see all of these statistics like, Tesla was valued at a stock price that, was larger than a whole bunch of other automakers combined. I think a lot of that right now is because people are viewing them as an AI play, related to, supercomputers, artificial intelligence, self-driving. And the truth is, I don't know. There's no question they have the resources, they have the intellectual horsepower. Elon Musk is phenomenal in these areas. He's done a great job at a bunch of companies in doing things that people thought were not possible. There's a lot, like there were certain things that Tesla does, their cars do, where their engineers said, we can't do it. And he said, yeah, you're going to figure it out. And they did. It was amazing. We all saw them launch a skyscraper sized rocket out of the earth and then have it come back and get chopsticked into place. I mean, their engineers can do really amazing things. But I don't want to pay that kind of valuation, fingers crossed, that they're going to figure out the AI model or the supercomputer model, or be the ones to figure out self-driving. And, one of the things everybody's talked about, and I think with good reason, Tesla self-driving is marketed as FSD, full self-driving. It's not. If I were driving a Tesla, like, would I engage the autopilot at times? If I need to take my eye off the road for a second, yeah, but I sure wouldn't be, sitting in the back seat watching a movie while the car drove itself. So I don't know who's going to win that stuff, and it's just not a bet I want to take. I don't have anything against the company. I know why people own it. There's certainly a technology leader and a market share leader and a hearts and minds leader. They've done incredible things, but that doesn't mean I want to buy the stock.
Makes sense. And yeah, I've been hearing more and more of that conversation of the idea of not just the Tesla car, but the Tesla concept, right? AI, rockets, the whole 9 yards, everything that Elon is leading and taking forward. That's thing number 4. And again, this is the 5 things from Deep Knowledge Investing. Be sure to head to our website, deepknowledgeinvesting.com. One other note before we get to this 5th thing too, check out the Ask Gary feature on the website. Send in questions via that form, or you can always email us, ir@deepknowledgeinvesting.com, with any questions that you might have. And sometimes, or might be lucky enough that we'll feature your question here on the 5 things, depending on how good it is. Thing number 5, Gary, talking the dollar milkshake theory. Don't worry, we're going to explain thing number 5, turning it to Alex, revisiting the dollar milkshake theory, why a soaring dollar matters.
Yeah, so traditionally when we do the 5 things, we always have a educational piece. And for the last few months, Andrew has been doing it. So this is the first week I've done the educational piece for the 5 things. And I thought it was appropriate that in this last week we saw the dollar, regain some strength. The Dixie got back to 108. And the dollar confuses a lot of people. I mean, they look at the US national debt, and it's, I believe, as of recording, it's around 36 trillion. And, there are very, cogent arguments to be made that because of that the dollar will weaken. And Brent Johnson outlines this kind of very interesting framework for kind of understanding the monetary system slightly with a kind of slightly more nuanced view, which is that yes, the US is in a lot of debt, but so are all the other countries. That's the first point. The second part is, in the 1950s, after World War II, there was innovations in the UK, where I'm from Midland Bank, where they started this offshore market, which is known as the Eurodollar market, whereby if I'm in the UK and you're in Germany and we do trade with each other, or I lend Germany money, that will be denominated in US dollars. It won't be denominated in pounds or euros. And so the BIS actually has an estimate that the offshore dollar market, the Eurodollar market, is $400 trillion. So that massively dwarfs the domestic US debt by, kind of 10 to 1 or 9 to 1. And so when US interest rates rise, when the dollar rises, all of these countries that are short these dollars, their expense goes up. They face interest rate risk and also currency risk. Now, the key part is that they owe money in a currency that they cannot print. So when the dollar rises and these countries get squeezed and they default on this debt, it creates this feedback loop of when you have a default, you have a credit contraction, and this pushes the dollar higher. And so that's kind of the essence of the dollar milkshake theory. And Brent Johnson gets a lot of stick on Twitter, but he makes some, you can see this happening. Every time there's a crisis, the US responds by weakening the dollar. They don't respond by trying to strengthen the dollar. And in the 2008 crisis, a lot of people see that that the housing was a big issue, but if you look into the fine details of it, it can be argued that a lot of the problems started in the Eurodollar market, and that a lot of the bailout money, in fact, about 90% of the bailout money went overseas, and a lot of it went to these Eurodollar banks. So you can see kind of how important it is understanding the dollar, but B, why the dollar keeps rising and stays strong despite the US fiscal situation.
Alex, now tell us what that means and how it relates to milkshakes.
Well, yeah, so I haven't actually watched the film, but I believe it's a film with Daniel Day-Lewis, which is from that meme where he puts his straw over the fence and he yells, "I drink your milkshake," as he's sucking up the oil, I believe, from his competitor. And it's, the US, as this kind of the sovereign debt bubble, unravels and worsens, all of the capital flows back into the US after these years of printing money and injecting liquidity into the system. Instead of injecting, they've now put in a straw, and as they suck this liquidity through the straw, the milkshake, the America drinks the world's milkshake, and we see this in U.S. equities, gold, and the dollar.
Gary, anything to add for this fifth thing?
Yeah. First of all, great description there. Great detailed description
Yeah,
by
very
Alex
well done.
on this. There's a very famous line from the 1970s where another country was complaining to one of our diplomats about the dollar. Similar situation to what Alex just outlined. And the response they got back was the dollar's our currency, it's your problem. Um, True, but from a foreign relations point of view, maybe not the best thing to have said. And 50 years later, people still remember it. The other thing that kind of stands out as really quirky is the dollar right now, and for decades has been everybody's flight to safety move. So when there's some sort of international problem or emergency or something really bad happens, everybody says, "Oh no, I don't want my money in risky assets. I want my money in safe assets." And so that flight to safety ends up strengthening the dollar and lowering treasury yields. As people buy treasury bonds, the price of those bonds goes up and the yield goes down. This is exactly what we were just talking about related to the Bank of China earlier in the segment. But where it gets really quirky is there have been times where the crisis event has actually been a crisis event in the US dollar. Like, the US has been bumping up against the debt ceiling, and there have been worries that, we would default or not pay the interest. And in those times, the dollar strengthens and yields go down. Now, that makes no sense at all. If people are saying, "Oh no, there's a problem with the dollar or US denominated debt," you would think that would weaken the dollar. But what happens is everybody's, instant response is, "Oh no, we have a problem. I don't want to hold risky assets." And they pile into the dollar. It is a completely predictable, understandable, but nutty response. The final thing that I'd add, and this is a point that I make probably once a month on this show, is Alex, I think, just gave us a great description of how these events conspire to strengthen the dollar at the expense of other currencies. And, half the people watching this are saying, "Well, yeah, the dollar's been really strong." When Alex is talking about Dixie, DXY is the ticker for the dollar index. It's how the dollar is performing against other large fiat currencies, right? So the British pound, the euro, the Japanese yen. And what Alex has done is he's given us a description of why Dixie, the dollar, has been strong from the point of view of a foreign exchange trader. And that's been true. Now, the other half of our audience is saying, "The dollar's strong. What are you kidding me? My paycheck is going less and less far. And have you not watched the last 4 episodes of the 5 things where you guys have talked openly about everybody saying we can't afford expensive luxuries and discretionary items. We're just spending more on, necessities." And that it takes me back to a point we've made many times before, which is the dollar can be strong from the point of view of a foreign exchange trader, but weak from the point of view of an American consumer. And so to give it, that may sound contradictory, but here's how it makes sense. The dollar is losing purchasing power. Other fiat currencies are losing purchasing power faster. Right. And so that's the answer. It's almost like relativity. These things are in motion together. It's just one part of the equation is moving down faster than the other part. So that's why we're suffering from inflation and a loss of purchasing power, but we're strengthening, by we, I mean the dollar, strengthening against other currencies. And so that's, I think Alex gave a phenomenal description. I'm just giving a little extra color from a macroeconomics point of view around the dollar milkshake theory, which is certainly worth, hearing about and discussing.
That closes out this week's version of the five things. As always, thank you everyone for tuning in. I know we've got Christmas, Hanukkah, Kwanzaa, New Year's, everything nowadays. Happy holidays to all of you. Thank you so much for watching. One note, we are going to be off next week. So there will not be a five things for next week, but we'll resume everything as normal programming goes. I believe that would be the 6th of January once everybody's back on holiday. Gary, I know you got some travel coming up, which sounds exciting. I'll turn it over to you for the final word of this week's five things, the Dollar Milkshake edition.
Yeah, thank you. So first of all, we're filming this on Monday, the 23rd, 2 days from now. We want to wish everybody a Merry Christmas and a Happy Hanukkah. We got our solar and lunar calendars on the same schedule, so everything starts on the same day this year, which is nice. We'll all be celebrating together. And Rob, you're right. This weekend, I take off for a multi-month trip. I will be going to Thailand. There I'll be in Bangkok and Chiang Mai, then to Vietnam, where I'm in Ho Chi Minh City, the former Saigon, and then to Da Nang. And then on the way back, I've arranged to spend the better part of a week in Seoul, Korea, a place I've always been fascinated by, but never really visited, with the exception of, one overnight on a flight there many, many years ago. So, looking forward to spending the next couple of months in Asia. Rob, you and I think, are going to be 15 hours apart. So we're going to have to find a good time to film the five things over the next couple months, but I know we'll figure it out. And for everyone else, as I always love to tell you, if you want to like and subscribe, we, love to have you along with us. But either way, thanks so much for watching. We know your time is valuable. Thanks for spending it with us. And one last thing, Alex, great job on this week's five things. Great to see you coming in so well prepared.
Thank you,
Thanks,
Gary.
thanks
All right,
everyone.
everyone. We'll see you in a
Thanks,
couple
Alex.
weeks.
Bye, guys.